Hey Inda, how's Sydney?
Hey Sean, how are you? Sydney is great.
Thank you for spending the time here today. We will talk about SIV products. We'll talk about our relationship, investors, international relationship, how to make money on behalf of investors, and the future of the migration program. Could you tell us a bit more about Mollis Australia, the company branding, people who are running it, the history and track records?
Sure. So Molls Australia is a listed company. We're listed on the Australian Stock Exchange. We are a financial services company, so we operate in a number of areas, including asset management, in corporate finance or M&A, and also in equity research and trading. So our business started in Australia in 2009 as a joint venture between a large US investment bank called Moelis and Company and local staff. And that started in 2009 as a 50-50 joint venture. And the business has been very successful and resulted in the listing of the business in 2017. Now, Moelis and Company is a large US investment bank. They remain an investor in Moelis. They've got a 19.5% share of Moelis still. And the gentleman over my shoulder here is Ken Moelis, who was the founder of Moelis in the US. And he remains a director on our board of directors. So we work very closely with Moelis and Company globally. They've got offices all around the world on transactions and cross-border transactions between Australia and Asia, the US and Europe.
How about yourself? Could you tell us a bit more about your background?
Sure. Thanks, Sean. Yeah, I'm a managing director here at MA Asset Management, which is the asset management division of Moelis Australia. And I work in the SIV team. So we look after all of our significant investor visa investors. I've been working in this industry for more than 20 years. Previously, I worked in London, in JP Morgan in London, and moved to Australia in 2006, and have worked here for a number of organizations, including ING Real Estate, Macquarie Bank, and now most recently with Moelis Australia.
I believe you are AFSL license holder.
Yeah, that's right. So Moelis Australia Asset Management holds an AFSL. So we've got an Australian financial services license, which allows us to offer funds to certain investors in the market. So we've been doing this for many years, and the team at Moelis Australia is very experienced. So previously I worked at JP Morgan. Our managing director or head of asset management, Andrew Martin, worked at UBS. He was formerly at UBS here in Sydney. And our vice chairman, Andrew Pridham, who established the company here, he was the head of JP Morgan for Australasia, and he ran JP Morgan here in Sydney. So as you can see, we've got a very experienced team who've been working in the finance industry for many, many years, very well known in the industry, and hopefully have a very good reputation in financial services in Australia.
So Inda, could you tell us about SIV product in general? What kind of product is it? And how is that regulated?
Sure. So Sean, let me just set out the rules of the framework that the SRV program operates under. So there's something called the Complying Investment Framework, which the Australian government put in place some years ago. And the SRV was first introduced in 2012. And then it was revamped in 2015, in July 2015, when the government put in place the rules which are currently in place. And the Complying Investment Framework was put in place by a government department called Austrade. And they are still involved in the program, which is now overseen by the Department of Home Affairs. That was formerly the Department of Immigration. So Sean, the Complying Investment Framework are the rules which govern the SRV program. And these are the rules that the Australian government have put in place in what you must invest in if you want to obtain a significant investor visa. The framework was revamped in 2015, and those rules remain in place today. And the requirements are that you must invest a mandatory amount or a minimum amount of 500,000 into an Australian venture capital or private equity fund, a minimum of 1.5 million or 30% into an emerging company or small cap fund. And then the remaining balancing investment or 60% of the 5 million must be invested in something, a fund investing in commercial property, in bonds or listed equities. So investors have a choice on what they invest in for that component. And generally, they will choose the investment that matches their preference for risk and return for that. For example, if you are very risk averse, you want a lower risk investment, then something like corporate bonds would be suitable for the balancing investment. If you want to get a higher return but are happy to take higher risk, then you would invest in listed equities for the balancing component.
So can I say that all of the SRV products that are allowed for the visa are highly regulated? They must be monitored by a government body. And how does the government check the compliance of the funds?
Sure, that's a good question. So in terms of regulation, Australia is actually a very sophisticated and quite a well-established financial services market. You know, this is the industry here, the funds industry is been in place for many, many years, because Australia has got something called compulsory superannuation. So everybody who works here must contribute a portion of their salary into their superannuation. As a result of that, it's a very well-regulated market. And the regulator for fund managers are called ASIC, the Australian Securities and Investments Commission. And ASIC issue licenses to fund managers, which is an Australian Financial Services License, or AFSL. Now, in order to offer funds to SRV investors, you must have an AFSL, and that's governed by ASIC, the Australian government. And it's quite a strict governing regime that they put in place. Now, in addition, with SRV, you've also got the Department of Home Affairs. They're the people who issue the visas, and they will also check to make sure that each investor has invested in the investments that they're required to. And they will require the fund managers to make a declaration at the beginning and at the end of the visa period to confirm that the investor has made the complying investments for a continuous period of 4 years. And if that's been in place and the investor has also fulfilled the minimum number of days in Australia, then the investor is entitled to permanent residency at the end of the visa.
So how about the return? You have spoken about the three components of the SIV product. Could you talk a bit in the details about that three components? For example, what about venture capital? They're required to invest $500,000 into venture capital, but is it risky? How risky is it? How does Moelis Australia manage the risk of this product?
Sure, that's probably the number one question we get asked by investors. So when we typically meet an SRV investor, for many of them, it's the first investment they've made outside of their home country or in Australia. For many of them, it's a new experience to even invest with a fund manager, to give their money to a third-party fund manager to manage on their behalf. So for them, it's something that they need to be comfortable with, and they have to do. Many investors will typically do a lot of research and due diligence on the person they choose to manage their investment, which is very important. So if we look at each of the components separately, let's start with VC. Now, as you mentioned, there can be a perception that the VC or venture capital or private equity component is high risk, and you're investing in early stage and startup companies and so on. And it's true that the venture capital is the riskier component of the complying investment framework. You know, these investments are in companies which are growing, but they're not liquid. They're not like shares on the stock market that you can buy and sell easily. So it's very important that when you invest in them, you spend a lot of time doing due diligence on the company, on the management, on the idea that the company or the product of the company produces. So that's something that our VC team would spend typically, 3, 4, or even longer months researching each of the investee companies that we make. Now, one thing we have in our company is we will generally co-invest in these investments ourselves. So we'll invest alongside our investors and put our own money into these projects. So they're the projects that we really believe in, they're companies that we like, and they're in industries that are growing or have got tailwinds behind them. And our VC team are very experienced in investing in these type of companies. They've been doing it for many, many years. So the first thing I'd like to say is, the VC component does not have to be high risk or does not have to be in very volatile companies. Quite often, these companies are very well established, they're revenue producing, they're profitable in many cases, and they're just raising money in order to grow, to expand, for example. A lot of Australian companies are limited by the size of the Australian market. So they want to expand to the US or the UK, and they will use money, they'll raise money from investors like us to allow them to hire sales staff and set up offices overseas and expand and sell their products to an overseas market, which of course is much larger than the Australian market.
And could you give us an example of, for example, a project that Moelis has invested in? How did that work out?
Sure. So a really good example this year was a company we invested in around about March of this year. Now, as you remember, I'm sure nobody will forget, in March, COVID had hit. And we had spent almost 4 months speaking to this company, researching them, going through their accounts, the management, and we really liked the company. It was a company that we believed in, and we wanted to invest in. But then, of course, COVID hit, and the world seemed like the world was going to end. It was a disaster. Markets were falling everywhere. So what we had to do at the time was we had to make a decision. Do we want to proceed with the investment, or do we want to or retreat? And after careful consideration, the investment committee that we've got for the fund decided to proceed. And this business was a company called CitrusAd, which is based in Brisbane. And their technology is used by supermarkets, online supermarkets in Australia, like Coles or Woolworths. When you're shopping online, it produces the technology that helps you find your products that you're looking for. Let's say a chocolate bar. You type in chocolate, the banner will show you the products that they've got, and it will promote certain products over others, like shelf space online. So we invested in the company. We backed them at the time when they needed capital. They wanted to grow and expand. They were targeting international markets, including the UK. And since then, of course, as we know, during COVID, many more people doing online shopping, particularly for supermarkets, and the business has thrived. So it's done extremely well. It's doubled its workforce, and they've won some very big contracts from US and UK companies, including Sainsbury's, which is one of the big supermarkets there. So that's been a great success for us and for the company, and it's allowed them to grow and expand and create jobs. And it's a really good case study of ways that the significant investor visa has benefited Australia. So it's helped Australia to grow, create jobs, and investors are also going to do very well from that company, which has now expanded considerably since COVID.
So how does that benefit investor? Like, what I'm asking is basically the exit plan. So the investor, they want the money out. So how's the return like if the company does well, or which company who don't do well?
Sure. So in that case, typically what we'll do when we're investing in a company like this will be, we will invest on a 3 to 4 year time horizon. So we're looking to invest. It's not a short-term investment. We're investing over the medium term. And in this case, a company like this will have two options generally at the end of our investment period. They can list on the stock market, which many of them choose to do, or they get taken out by another purchaser through a trade sale. So quite often, a bigger player in the market will come and buy them and buy their technology and buy their staff and use them to expand their own. So either of those exits is quite likely. Now that exit, obviously, we have no control of when that happens. But what we'll try and do is we'll try and be actively involved in the business, actively involved on the board if we can, to make sure that we can ensure that our exit happens in time for our investors, who are all investing for 4 to 5 years, which is the term of their SRV program. So the timing should work out very well for them. In the case of this company, it's hard to say, will it be a listing or a trade sale? But based on their growth to date, it certainly looks like an exit will happen in the next few years.
And since it's called venture capital, there are risks, higher risks than the other investments. So sure. What if a company just the investment fails?
Correct.
What will happen?
And that can happen. I would like to say though that under this component, venture capital is generally, you're right, generally are startups, early stage ideas and concepts. But actually, it doesn't require you to invest in those companies. Private equity or growth private equity is actually typically closer to what we invest in. So these are companies that are already established, already revenue producing. Effectively, they've been through the early stage startup, which is the riskier time. Now, our investors, as I mentioned before, are generally risk averse. So they want us to protect their capital. They want us to ensure that their money comes back at the end. So they're happy to take less risk and in return, slightly less return. So we will typically invest in later stage companies, growth private equity rather than venture capital. But venture capital is an option for investors. They can choose to invest in earlier stage companies, which typically would have a much higher return, but obviously a higher risk. Or they can choose to invest in later stage or growth private equity or expansion capital companies, which have lower risk, but should have a lower return as well. And investors can make that choice when they're choosing the fund to invest in for their SRV. they will typically choose the fund that matches their risk and return appetite or their profile.
How did the past performance of venture capital funds Moelis has invested in, how did that work out?
Sure. So we've actually got a very good track record. Our investors have been very happy to date. So our first fund, we're now in our second fund. The first fund closed in 2018. And out of the 10 investments we've made, 5 have already exited. So we've returned our capital to investors. Now, it's very important to note that under the SRV program, the rules require you, when you get a return of capital and profits during the term of your 4-year visa, you must reinvest them back into the complying investment firm program. So that means typically investors will get their money out of VC and they'll reinvest into something else. It could be bonds or equities or property. And then that must remain invested until the end of their visa. But what that means from an investor's perspective is if you invest 500,000 on day one, quite quickly you can start to get that money back and the VC component will reduce over time. Many investors, for example, will choose to put the money into bonds as soon as it exits from VC, and that reduces the risk profile of their investment considerably. So it is an option for you to, as the money comes back, to reinvest it into something safer or lower risk, like bonds, and many investors choose to do that.
Okay. The second component SRV of the SRV framework is called small caps. The investor must invest $1.5 million into the ASX listed company stock market, right? And that has some restrictions. How does that work? How does a small cap component work? Why does the government enforce that? Compare with the rest of the balance investment, how does that help the economy? And what's the return of the small cap investment like?
Sure. Well, let me start with that part. So in 2015, when the government revamped the significant investor visa program, they had a mandatory requirement for each investor to invest 10% into venture capital private equity and 30% into emerging companies or small caps. Now, the reason they did that is they wanted to direct more money into the productive economy to help stimulate the economy and help growing companies or emerging companies who would in turn create jobs and export and so on, help the Australian economy. So they had a mandatory investment in this case of 30% or 1.5 million into listed companies on the stock market, which were under $500 million market cap. So this component are listed shares, they're equities. There's a mandatory investment. You must invest at least that. You can invest more than, if you like, than 1.5 million, but they're in listed shares on the stock market, and they must be under $500 million at the time you first invest. Now, there's quite a number of rules applying to this section in terms of the amount of cash you can hold, the number of holdings you can have, and the size of the companies, how big they can be. So in general terms, you need to choose a fund manager who can monitor this actively and actively manage it. You asked about returns. This component obviously is higher risk than some other options out there. But in general, listed equities in Australia have had a very good performance over the medium, especially over the medium to long term. So for most investors who are investing for their visa for 4 years, in general, these funds will have a positive return and should outperform other asset classes like bonds, for example, over that time. Let's take, for example, last year. So we have a very good case study this year of the first half of 2020 when we had COVID. Of course, at the time, the markets fell very dramatically in March as COVID first hit and countries went into lockdown, including Australia. But what we've seen since then is the markets have rebounded very strongly. The Australian economy is very well prepared. We've handled COVID very well. And as a result, equity markets, including the small caps market, has rebounded strongly. And even last year, which included the last 6 months of the year, our financial year here, which included COVID, our fund, for example, was up 6.5% for the year, despite all of the turbulence. So our investors generally are quite happy with this return. Their return for the second half of the year is going to be very strong as well. And most investors in this fund will be very pleased when they see the return that they've achieved during 2020.
So how does Moelis decide on which product to invest in terms of small cap? Do you have an analyst team? How do you decide which one is the best for the investor?
We do. So Moelis has a lot of experience in the small caps or listed small cap sector. We have a very strong research division, which focuses exclusively on small cap companies. We cover more of them than anybody else. And our fund manager for the fund, John Garrett, he's been doing this for many years, so very experienced in the area of equities and investing. So he's a very careful investment strategy. And his number one focus of this obviously is to protect Visa. So we must protect investors' SIV. We must only invest in things which are allowed under the complying investment framework. And secondly, we must protect capital. So investors are generally want us to make sure that we return their capital to them safely after the 4 years is up. So the companies that John will invest in are good, solid companies that he has strong balance sheets, have got strong management alignments, and are in industries that he believes have a strong future or have tailwinds behind it in Australia. Now, it's also a very diversified portfolio. So what that means is there's going to be more than 50 companies. When you invest in this fund, you will have exposure to more than 50 different companies in different sectors, in different asset classes, and so on, which means you're spreading your risk across many different companies over this 1.5 million component. So that's been our strategy from the beginning, is a very thorough research-driven selection process for the investee companies and a diversification. So we're spreading the risk across, as I mentioned, over 50 different companies in this component. And that's proven to be a very good strategy. It's held up well during periods of turbulence such as COVID earlier this year.
Okay, then the third, the remaining part, which is the balance investment, 3 million or less, up to your choice. That's usually the most profitable and investors' favorites. Could you talk about that? Are there any restrictions at all? And what are the returns like in there?
Sure. So the balancing investment is where investors have an element of choice. This is where they can choose for 60% or for $3 million of the 5 what they invest in. Now, your choice will generally be driven by your risk appetite, how much risk you like to take and how much return you're trying to achieve. So at one end, we've got corporate bonds. Corporate bonds, particularly those issued by the big Australian banks, which is the majority of the market here, would be considered a very low risk or secure investment. But at the moment, we find interest rates are very low in Australia, so the returns will generally be low as well, along with the risk. So many investors in the last year, for example, prefer to invest in bonds, given the uncertainty and volatility in the market, which was a valid option. The other option investors can choose for this component is commercial property. So they can invest in a fund which invests in commercial property. And by that, I mean shopping centers, hospitals, restaurants, hotels, retail malls, offices, logistics, warehouses, this type of thing. So everything other than residential. Residential property is not permitted for this component of the investment. And investors at the moment, given interest rates are very low, commercial property had a very strong return over the last couple of years. So that's also a very popular option. And then finally, the other option investors can choose is listed equities. So they can invest in shares on the stock market. And this doesn't have to be small companies. It can be large or small for this component. But obviously, that would be a more volatile or higher risk investment. So investors who prefer lower risk would generally not choose to invest in listed equities for this component, but it is an option. The other thing to note is during the 4-year period of your visa, you are allowed to switch between investments. So you, for example, may start investing in bonds. You want to have a very start at the beginning with a more conservative portfolio. And then over time, as you get more familiar with the market, or more comfortable with Australia as an investment, you may switch from bonds across to equities or even property.
Does a switch cost money?
No, you can switch generally. If you're switching between funds with the same fund manager, generally you can do that at no cost. But under the rules of the visa, you must do that switch within 30 days. So when you leave one fund, you must enter the next fund within 30 days. Otherwise, your visa may be impacted. So switching is permitted, assuming that the fund allows it. Switching out of the fund and into another is an option as well during the period of your visa. So you do have some flexibility. And the other thing to say for the component of the balancing is you don't have to put everything in one. You don't have to put all your money into property or into bonds. You can mix. You can put some in property, some in bonds, some in equities. And we have a number of investors who like that. They like to have a portfolio which is diversified across different asset classes and sectors, which means they're not too exposed to equity markets or to property markets at any time. And it's a way of spreading their risk across different asset classes.
And how does the return look like, especially due to COVID, and also the lower interest rate? On average, the investors won't ask for what the investor looking for is an average return, roughly how much annual return would they generate. Some of them thinking they might be losing money. Is that the case?
Sure. Well, certainly not. Even during COVID, we found that investors' portfolios have held up very well. So if you invested in bonds, they would have been rock solid during COVID. The returns have reduced because interest rates have reduced here. But you effectively have two choices. You can invest in fixed rate, which is, as the name suggests, the returns are fixed for the term of the investment, or floating rate, which is generally tied to the RBA cash rate here, which is currently at record lows of 0.1%. So investors who invest in bonds right now, particularly you're looking at very secure bonds issued by the big banks, the largest companies in Australia. Those bonds, you're probably getting a return of about 1 to 1.5% after all fees. If you're happy to take a little bit more risk and invest in bonds issued by different companies or higher risk companies, you can get a higher return. But generally, the return on bonds will be low because the risk is low. Now, on the other hand, a commercial property fund, you will be getting somewhere between 5, 6, 7% returns, depending on the asset class. So it could be in offices or logistics buildings or hotels or retail malls. The returns on those investments will vary, but generally they'll be between 5, 6, 7% returns on those, depending on the asset class.
Per year, annual return.
Per annum. Per annum, yeah. And then equities can be more volatile. It's very hard to predict equities. Some years can be high, some years can be low. And it depends on the sector or which particular sector you're investing in as well. Generally, equities is a more long-term investment. So if you're investing in equities, we generally advise our investors to look at it as a medium to long-term investment, not a short-term one, because in the short term, it's very hard to predict. Anything can happen. But we know historically over the longer term that equities have performed very well here in Australia.
I understand. In terms of the risk versus return, we all understand high risk, high return. So in terms of your balanced investment product you offer, could you list from a lower risk to a higher risk?
Sure. If you look at the menu, and generally we'll have, at any one time, we'll have between 7 or 8 options for investors to choose for the balancing investment. At the lower end risk of the scale, you've got bonds. And even within bonds, there are different categories of bonds that you can choose. But in the more secure bonds or senior secured bonds, you're looking at a lower return of, as I mentioned, 1 to 1.5%. The medium, risk would be commercial property. And again, you can reduce your risk in investment property or commercial property by investing in properties with long-term leases to good quality tenants. For example, we've just got a logistics fund which invests in warehouses or logistics distribution facilities, which is leased at the moment on 15 years to a listed company. So very secure, rental income is locked in, guaranteed over a 15-year period. So that's an investment which will be at the lower risk end of the commercial property scale.
Okay.
Then finally, equities, it would be what I would consider the highest risk. So equities can be volatile. It's, at the end of the day, the markets can sometimes be unpredictable, as we found out this year in March. But as I mentioned before, equities, in generally over the medium to long term, equities have had a very positive return for investors. So as long as you're willing to take a long-term view on equities, it can deliver a very strong return. And in our case, our equity funds have actually been our best performing funds over the past 5 years.
Okay, and thank you. I understand Moelis is not a company does SIB products only, and investors are generally looking for better and good opportunities for investment and investment products. So what other products may Moelis offer to non-SIB investors or investors who want to invest in addition to the $5 million? How do they compare to the SIB compliance products?
All right, Sean, it's a good question. Yeah, we have investors, of course, once their visa, they've got their permanent residency, the 4 years is up and they've got permanent residency, they're free to invest in whatever they like in Australia. So they're free to withdraw their investment and then reinvest in other funds. And also we have many investors who've got additional funds that they're looking to invest here as well. As you mentioned before, currently the interest rate is very low in Australia, so returns are quite low in the bank, in cash. So we've got a whole range of funds investors can choose from. And once you're outside of the SRV complying investment framework, you really have many more choices to choose from. So one of our most popular options at the moment is in the area of credit. So we will do lending to companies or individuals, which is secured by assets like real estate or inventory or other property and plant. So our credit division is quite large. We're one of the largest non-bank lenders in Australia. And this is a good way to earn a good return while still making a secure investment, which is secured by an asset. And we've got area funds called our fixed income fund, our secured loan priority fund, and also our private credit fund, which offer different returns to investors, varying between 4% and 8% per annum, depending on their risk profile. So outside of the framework of the SRV, you've got many choices open to you. We've got investments in private equity, we've got investments in property, we've got investments in bonds, investments in credit. So if investors are interested to learn a little bit more about the options they've got, they're happy to contact us anytime and we can send through information.
So in terms of the non-SRV compliant product, what are the general return, in the past few years or maybe in the future, on average, annual return look like?
Okay, and it really depends on the sector you're investing in. Our funds are generally, not trying to take too much risk, trying to make conservative investments. And in the area of our credit funds, we're secured by something. So you've got security over an asset, which protects investors as well. So the returns will generally, for our fixed income fund, it's about 4% per annum. Our secured loan fund is generally about 5 to 6% per annum. And then private credit fund, which is generally 7 to 8% per annum. So investors, depending on how much risk they're happy to take, can achieve returns from 4 to 8%. And then from time to time, we have other investments in things like private equity, commercial property, and so on. And they should have a higher return, but they will have a minimum investment period of, say, 3, 4, or 5 years. So the higher return means you are invested for a longer period of time. So at any moment in time, we have other options which investors can choose. So investors are free to reach out to us, contact us anytime if they'd like to know more information.
And if they are not SRV client, they are overseas investors, they can still choose to invest in your non-SRV or even SRV investment products?
That's right. Yep. So investors are free to invest overseas, or domestic investors in Australia are free to invest with us. And we have many investors who do that. So many investors who were SRV investors have now got their permanent residency and have chosen to remain invested with us because they've been happy with the returns that they've achieved over the 4-year period. Plus, we have investors from overseas who are looking to invest in Australia. They like the Australian economy. They like the fact that it's a growing economy, very stable politically, and they want to invest some capital here as part of their global wealth, to diversify their global wealth around the world. And Australia is a very attractive destination for them to invest in right now.
How about the FRB, foreign investment approval, as a foreigner? If you don't have Australian permanent residency, sure, there are additional requirements. And we, of course, have heard rumors on the new FRB rules, and foreign investors must receive permission to invest in the products. Could you clarify these?
Sure. So that's a good question, and it's something we've been dealing with this year. So FIRB means Foreign Investment Review Board. And this year, the Australian government introduced some new laws, which means that FIRB must approve investments by foreign investors into certain asset classes, such as property or certain companies. Now, previously, there was a minimum threshold you could invest without FIRB approval, and this year they've reduced that down to 0. So everything must get approval. So it's one of the advantages of investing in a managed fund, like one of the funds that because our responsibility to get FIRB approval. Investors can freely invest into the fund, but then the fund, if it's got more than 40% of its investors from overseas, must get approval from FIRB for its asset classes. And that's something that we do. So it's our responsibility. And in the case of a commercial property, if we're acquiring a commercial property on behalf of a fund which is deemed foreign, we will go to FIRB and we will get approval to acquire that property. And it's a process we've done many times before.
So you will do that on behalf of investors.
We will do that.
They don't have to worry.
Investors don't have to worry. So
That's good.
One of the benefits of investing in a managed fund like this is the responsibility is ours. Whereas investors investing directly themselves will have to go through the process with FIRB themselves, which can be more complicated. So the fund is responsible, the fund manager is responsible for obtaining FIRB approval to acquire assets if they've got a certain number of foreign investors in the fund.
And at the same time, if they wanted to invest in themselves, like buying properties or purchase a warehouse, they will need to do the FIRB themselves.
Correct. So what we'd normally advise, if investors want to do that themselves directly, then they should obtain good advice, from a lawyer or somebody who's experienced in this type of thing, and they will have to go through the process of getting approval from FIRB to make that acquisition.
We have heard some bad stories in the past several months or a couple of years. There had been some funds who ran into trouble and investors have lost money. And they were SRV approved funds. But how do we tell which fund is good or bad? And
Sure.
How do we choose? And how do we avoid the potential losses?
Sure. It's a good question. Yeah, there have been some high-profile failures or high-profile cases of fraud here, unfortunately, and they have involved SRV funds. So I think what's very important for investors is when they're choosing the fund, that they do a very extensive due diligence on the fund manager. Who are they? Who are the fund manager? Who owns them? Do I have transparency on the ownership, on the balance sheet? What's the financial position of this company? Because you want to make sure that that company is around in 5 years' time when it comes to you getting your permanent residency. So it's very secure. If the company is listed, for example, they will have audited accounts that you can check. You can check the results announcement. Any material change will have to be publicly announced to the stock market. So that's a very good way. By choosing a listed fund manager, you know exactly the financial position of the company, how strong they are, how much cash on their balance sheet. So that can give you a bit of comfort. If the fund manager is not listed, you don't really have no certainty on who owns them or how strong the company is. The other thing to check, of course, is track record. How long have these people been involved in funds and fund management? What is their track record? Where have they worked before? What is the performance of their investments previously? So you should be looking for people who've worked in the industry for many years, for the big names, for example, the big banks, etc. Here, that should give you some comfort that these fund managers know what they're doing, they're experienced, they're well known in the market and well respected. So track record is the second thing. And then the other factor you should check, which is very important from an SRV perspective, is how experienced is the fund manager in dealing with SRV funds? So has this fund manager dealt with SRV investors before? Have they a track record of success of investing on behalf of SRV investors? Because of course we know it's not just about performing well in the investment, it's also about protecting investors' visa. So we need investment fund managers who are very familiar with the SRV rules and have got systems and procedures in place to protect the SRV during the period that you invest with them. So those three factors are probably the things investors should research most: the track record, the background and the financial position of the company, and also the experience in the SRV program.
Okay. A lot of investors would rely on the suggestion of migration agents. I suppose we play a very important role. But all we can tell our investors is to not only hear what they say, but also do the research and understand the background of the fund manager, but also the background of migration agents as well. There are a lot of migration agents who you thought they're migration agents. No, they're not even registered, and they're just salespeople. And we suggest stay away from them because they're not responsible.
I agree, Sean. I mean, investors should use registered migration agents like yourself. We've known you for many years, very honest and trustworthy, very reputable, who have done this for many years, who are registered and very experienced in doing this type of visa. So it's very important in Australia to choose professionals who are qualified to do what they're doing. For example, to submit a migration or a visa application on your behalf. But likewise with tax and accounting, to choose experts who are qualified to provide this advice. And that goes for fund management as well, to do your due diligence and do your research on who you're choosing or who you're paying to submit your application and to make your investment.
This is probably a question outside of the SIV product, but I still want to ask you, as you are a very experienced fund manager for so many years. From my observation, many Chinese investors, they don't understand how professionals work in the Western society, and they don't plan to pay money. They incline to pay money for professional opinions. As a Westerner, what's your view on that?
Look, you're right, Sean. We have seen that in the past. Investors have been reluctant sometimes to pay for professional services like tax, migration, and accounting advice. But what we've seen over the last couple of years is that can sometimes end in disaster, as we saw with the high-profile cases recently of funds that blew up. Those people were poorly advised, so they got bad advice from people who were not qualified to either make the advice or to make the investments. So our recommendation here is, it's a very well-regulated market here across all of the industry. So migration, you've got a migration regulatory body, which you must be registered with in order to submit. Also with funds and tax, just make sure that the people that you're using are experienced, they've been doing this for many years, and they're qualified. They've got a qualification to provide the advice that you've asked them to do. And we generally find it's worth paying for that service. You pay for the high quality service will protect you in the long run. And we've seen that people who haven't done that generally have suffered because they've been poorly advised.
The Australian government have announced that they will make changes to the BIP program, which is the Business Innovation Investment Program. That would include the SIV program. And I think the change will happen on the 1st of July, 2021. But as an insider, what news have you heard? Could you share some of your insights on how the SIV program, including other 1AA, A, B, C, D, E, and 132, how they will change?
Sure. Okay, yeah, you're right, Sean. The government have indicated in the recent budget in October that they will make some changes to the Business Innovation and Investment Program, which includes the SIV, and those changes will be implemented on 1 July 2021. So they will only apply to people who apply after that date, after July next year. And those changes, we don't yet know what the changes will be, but we can, assume based on what the government have said in past announcements. It looks likely that they want to simplify or streamline the process. So they want to reduce the number of visas on offer and just focus on a certain categories of visa classes. Now, one thing we can say with reasonable certainty is the SIV program is here to stay. I think the government have demonstrated, certainly this year, that it's a top priority for them. And we think the SIV program will be in place for many years to come. In October, the government doubled the number of business innovation and investment places for next year. So they increased it from almost 6,500 to 13,500. And that demonstrates, at a time when most other visa classes have reduced, that the government is very keen to attract investors and entrepreneurs and business people to Australia, because they know that those people will help Australia recover from COVID and from the current situation, economic situation. The second thing they've done is they've prioritized SIV investors. So they've said these investors will get priority processing. And we've already started to see that, in that processing times are now much less than they were in recent years. So the processing times are a lot quicker for SIVs. And thirdly, the business investor visas, or like SIV, have been given an exemption to travel to Australia. And this is one of the very few visa classes that are actually allowed to visit Australia now. Along with permanent residents and citizens, they can come here subject to quarantine. They have to do 2 weeks quarantine. But I think that also demonstrates how highly valued the government places these investors, and by giving them priority, or by giving them the ability to come to Australia at this time when almost no other visa classes are allowed to come here. So I think we can say for certain the SIV is here to stay. The government may look to increase the investment threshold from 5 million to a higher amount. We're not sure. We hope that it remains at 5 million, but that's a possibility. And they may also increase the amount of venture capital you must invest in, which is currently 10%. Again, these things are not certain, but I think we can say with great certainty that the SIV is here to stay, and it's something the government will hopefully promote and prioritize in the next few years.
It's certain to say that SIV will stay and the government will prioritize that, yeah? That's good news for all the potential business migrants. Many of our clients don't speak the language of English. How can Moelis support them or communicate with them?
So we've built up a very strong Chinese-speaking team over the years. We've now got colleagues in Shanghai, 2 in Shanghai, 2 colleagues in Beijing. We've got 2 in Hong Kong, including a Cantonese speaker, and we've got 2 in Melbourne. So we've established a client relationship team of almost 20 people now who've got language capabilities, particularly in Mandarin, Cantonese, and also Vietnamese. So that allows us to help our investors, to explain to our investors about the funds that they're investing in and the performance of the funds, and also allows us to develop a very strong relationship with our investors over the medium to long term.
And you have branch offices, or you have offices in China. If an investor wants to meet with them, they will visit them in big cities. How does it work?
That's right. Yeah. So if investors in China want to meet with our team, our team will be happy to come and meet them, or to meet them at our offices in Shanghai or Beijing, or come to visit the investors in their home city as well. We do that. Our team do that all of the time. Generally, you'll find as well that all of our fund material and our reports and even our online login or access is all available in Mandarin and English. So we want investors to feel comfortable, to be able to understand what they're investing in, and also to be able to understand the reports that we send them every couple of months. So we have a very strong focus on our client relationship team, and also on providing a very good service to our investors, be they from China or elsewhere.
Obviously, we live in a very complicated world. During the COVID time, we have seen so many conflicts. And now, of course, between China and Australia, the relationship is really tense. Do you think that's going to impact on the Chinese investors and Chinese migrants? If so, how will that impact on them? And what is the future? No one will know, but what do you think the relationship will go? It will go south or go better soon? What's your Moelis view on that?
Sure. Yeah, you're right, Sean. There's no doubt about it. The current relationship is not at its best level. In fact, there's been this year it's deteriorated during the course of the year, and to the state where both governments now are on bad terms. Now, from our perspective, we don't know. Nobody does about what will happen. But I think what we can say and what we've seen is the desire for both countries to invest at an individual level or company level. We have not seen anything change there. So we still have very close relationships with Chinese Australians, and also investing here, and also Australians investing back to China. And that has not changed this year. So notwithstanding the dispute between the government at government level, what we're seeing with individuals at individual level is there's still a strong desire to work together, to partner on projects and investment projects. And certainly we're certainly doing that. So we're investing in our business in China, and also we have a lot of Chinese investors who are still investing down here. So we're hoping this is a short-term blip. We're hoping that things can be resolved in the next year or two, and things return to normal, and Australia and China's strong relationship works together, particularly at a business level. So we're, as you know, we're active members of the Australia-China Business Council, and that organization has been working very hard to foster relationships between businesses in Australia and in China. And that continues to this day. So we actively work with individuals and with businesses in China from day to day, and that hasn't changed this year. So I'm hoping that we can move through this, that relationships can improve, of course. Everybody wants that to happen. But at the moment, we're not seeing any slowdown or any any pullback in the desire to invest here from Chinese investors to invest here, or for Australian investors to invest back in China as well.
Thank you, Enda, for spending the time today with us explaining all the details about SRV program and the services provided by Mollis and your team. I appreciate your time. And if we have investors who wants to understand more about Mollis product, we will introduce you to them.
Thank you very much, Sean. It was a pleasure. I look forward to speaking with you again.
Thank you.